Assalamualaikum and greetings to all of you. Today, we're going to learn on the chapter 10, which is the dividend policy. There are two learning outcomes for this chapter, which is illustrate the corporate understanding toward dividend policy, dividend payment, and dividend controversy. Also to understand the concept of stocks dividend and stock split as the method of the dividend payment. The chapter outline for this chapter are: the first one, how firms pay dividends and repurchase the stock. Second, how do companies decide on payouts. The third one, the payout controversy. And the last one is the stock dividend and the stock split. So what is dividend? A dividend is the distribution of some of the company's earning to a class of its shareholders as determined by the company boards of directors. Common shareholders of dividends-paying company are typically eligible as long as they own the stock before the ex-dividend date. So dividend is a payment made out of the earning to its own owner in form of cash or stocks. The primary source of dividend should come from the company's retained earnings. As much as possible, it gives back to the shareholder. In terms of the distribution, payment made by the firm to its owner from the source other than the current or retained earning. Thus, dividend may be paid out as a cash or in form of the additional stock. There are several types of a cash dividend are known as. The first one is the regular cash dividend. A cash dividend is a distribution of a fund or money paid to the stockholder, generally as a part of the corporation's current earning or accumulated profit. The regular cash dividend are paid directly in money as opposed to being paid as a stock dividend or other forms of value. So usually regular cash dividend are paid directly to the shareholder. Second is the extra dividend. Extra dividend, or sometimes called a special or irregular dividend, is a one-time dividend paid to a company's shareholders of a record. Unlike most dividends, which are paid at regular intervals and in predetermined amount, extra dividend are typically announced with a little to no warning, usually for significantly in large amount, and are paid in cash. So usually the extra dividend may not repeated in the future. The third one is the special dividend. A special dividend is a non-recurring distribution of a company asset, usually in the form of cash to shareholder. A special dividend is usually larger compared to normal dividends paid out by a company and often tied to a specific event like an asset sales or other windfall event. So special dividend, known as an unusual paid dividend. And the last one is liquidating dividend. The liquidating dividend is a type of payment that a corporation makes to its shareholder during a partial or full liquidate. So liquidating dividend is when the business has been liquidated or has been sold. Next is the chronology of the dividend payment. So let us go through step by step on the chronology of the dividend payment. So the first one is known as the declaration date or the announcement date where dividends are announced by the company management on the announcement date or on the declaration date and must be approved by the shareholder before they can be paid. Second step is the ex-dividend date, where the date on which the dividend eligibility expires is called the ex-dividend date or simply the ex-date. For instance, if a stock has an ex-date of Monday on January 28, then the shareholder who buy the stock on or after that day will not qualify to get the dividend as they are buying it on or after the dividend expiry date. Thus, the shareholder who own the stock on the business prior to the X date, that is on the Friday, January 26 or maybe earlier, will receive the dividend. The third step is the record date. The record date is the cut-off date, where established by the company in order to determine which the shareholders are eligible to receive a dividend or a distribution. And the last step is the payment date, where the company issue the payments of the dividend on the payment date, which is when the company gets the credit to the investor account. Now, let us go through on the types of dividends. The first one is the homemade dividend. There are several questions regarding the homemade dividend. So the first one is when the company decides to pay dividend, how much it should pay, and can a company just simply change the dividend policy? But before that, let us know what is the dividend homemade. So the dividend homemade are a form of investment income generated from sales of the portion of an individual's investment portfolio. These assets differ from the traditional dividends that a company's board of directors distributes to the certain classes of the shareholder. So the homemade dividend are unlike the traditional dividend that a company's board of directors issues to the shareholder. So, if the investor or the shareholder disappointed with the dividend policy of the company, they can manage the dividend policy accordingly to their needs, as they can borrow or reinvesting their dividend, and also they might selling the share of the stock. Next is the clientele effect. The clientele effects explain the movement in the company's stock's price according to the demands and the goals of its investor. These investor demands come in the reaction of a tax, dividend, or another policy change or the corporate action which affects a company's shares. The clientele effects assume that a specific investor preliminary attract to the different company policies, and that when a company alter one or more policies, they will adjust their stock holding accordingly. As the result of the adjustment, the stock price can be fluctuate. Thus, some investors prefer low dividend payout and they will buy the stock in the companies that offer the low dividend payouts. And other than that, some investors are most likely prefer high dividend payout and they will buy the stock in a company that offers the high dividend payout. The implication of the clientele effects. There are several questions need to be answered in the clientele effect. So the first one is, what do you think will happen if the firm change its policy from a high payout to the low payout? Second one, what do you think will happen if the firm change its policy from a low payout to the high payout? If this is the case, does a dividend policy matters? Here's are the example. High growth stock traditionally do not pay dividend. However, they are most likely to exhibit the substantial price appreciation as the company grows. On the other hand, the dividend-paying stock tend to show a smaller movement in the capital gain but reward the investor with a stable, periodic dividend. Shareholders in a dividend clientele generally base their preference for a particular dividend payout and comparable income level, personal income tax consideration, and also on their age. Next is the stock repurchase. A stock repurchase is a transaction whereby a company buys back its own share from the marketplace. A company might buy back its share because the management consider them undervalued. So the company buys the share directly from the market or offers it to the shareholder the option of tendering their share directly to the company at a fixed price. Or in other words, there is another method to pay out a firm earning to its owner to avoid the pay dividend every year. So usually a company pay cash to the shareholder or repurchase its own stocks. In the stock repurchase, the shareholder pay tax if the shareholder choose to sell the stock and the shareholder have a capital gain on the sale. So there are several keywords that you need to know on a stock repurchase. The stock repurchase, or known as a buyback, it is a decision by the company to buy back its own share from the marketplace. And the company might buy back its share to boost up the value of the stock and to improve the financial statement. The company tend to repurchase when they have a cash on hand and the stock market is on upswing. And the last one, there is a risk that the stock price could fall after a share repurchase. So there are several advantages on the stock repurchase. So the first one is to avoid paying dividend every year. And the second one is to provide more preferable tax treatment when the dividend without tax and the transaction costs. So usually the company buy its own share stock through tenders offer, open market, and the stock repurchase. Next is the stock dividend. A stock dividend is a dividend paid to the shareholder in form of additional share in the company rather than as a cash. So the stock dividend is a pay additional share of stock in increase the number of the outstanding share. So the stock dividend are not taxed until the shares granted are sold by their owner. Like the stock split, the stock dividend dilute the share price, but as with the cash dividend, they are also not affect the value of the company. So the payment to the existing shareholder is in form of the stock, rather than giving out the shareholder in terms of cash. Next is the stock split. So the stock split is when a company divide the existing share of its stock into a multiple new share to boost the stock's liquidity. Although the number of shares outstanding increase by a specific multiple, the total value of the share remain the same compared to the pre-split amount because the split does not add any real value. So the stock split usually expressed as a ratio or a stock's price decrease. It is a way to create more number of share, but it has to reduce the par value. So the reason is the company feel the price of the share is too high. So the stock split does not have any effect on the capital structure. Accounting effect to the balance sheet or the stock dividend and the stock split. As you can see here, there are differences between the stock splits and the stock dividends in terms of the numbers of the common share, the par value, value of the common stock, share premium, retained earning, and total net worth. As we can see here, in terms of the number of the stocks, there is the increase in both stock dividend and stock split, while there is unchanged in terms of stock dividend in the par value, and the par value for the stock split is declined. Next is the value of the common stock. The stock dividend is increased, but stock split is unchanged, while the share premium also increased and the stock split is unchanged. Meanwhile, the retained earning declined in the stock dividend, but unfortunately for the stock split it is unchanged. But for the total net worth, both of the stock dividend and stock splits are unchanged. The differences between cash dividend, stock dividend, and the stock split. In terms of the methods of payment, as we can see here, the cash dividend, the payment is made by the company out of its earnings to the investor in form of the cash. While for the stock dividend, the company issue a new share to the stockholder in some portion to the shares outstanding. While for the stock split, it reduces the par value per share of the stock outstanding. So there are several effects to the firm. The first one is for the cash dividend. It is reduction in the retained earning, and the company can then create a liability on its balance sheet, which is the dividends payable. While for the stock dividends, the effects to the firms is the company share outstanding will increase and the company's stock price will be decreased. The stock splits effect to the firm is increase in the number of share outstanding and reduce the par value or the stated value per share of the company's stocks. The last one is the effect to the shareholder in terms of the cash dividend, where the shareholder receive a cash. Shareholders' wealth creation realized immediately. While for the stock dividend, their existing shareholder will see their shareholdings double in quantity, but there will be no change in the proportional ownership represented by the shares, and there is no changes in the shareholders' wealth. So for our last slide, there are factors that influence the size of a dividend payouts. As you can see here, there are 4 factors that may influence the size of dividend payouts. So the first one is the stability of the earnings. So since the dividend can be paid out from the profit only, so the profit is an essential requirement for the dividends. company with a stable earning can adhere most closely to a stable dividend policy than a companies with the fluctuating earnings. Second, the investment opportunities. The company with profitable investment opportunities relative to the available cash flow tend to retain more of the earnings from the reinvestment and hence will have a low payout ratio. The third one is in terms of the legal restriction. The law may restrict the firm using the fund raised from a new security, either from bonds or share, to pay the dividend. And the last one is the inflation. In the period of the inflation, the replacement cost of a fixed asset are higher and hence the companies pay fewer dividends. Thank you for listening.